Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LIMBACH Holdings INC quarterly report. LIMBACH Holdings Inc. offers a wide range of services to various industries. The company's key businesses include construction and renovation, projects, mechanical, electrical, and plumbing services, professional and consultative services, replacements and retrofit solutions, rental equipment solutions, maintenance, and repairs, energy efficiency solutions, decarbonization roadmap solutions. The company serves various sectors, including healthcare, hospitals, research centers, education, colleges, universities, research centers, entertainment facilities, amusement parks, technology, data centers, manufacturing, automotive, energy, general manufacturing plants, life sciences, organizations focused on living things. LIMBACH Holdings Inc. Stock price drop. A year of disappointing earnings reports over the past year. LIMBACH Holdings Inc. LMB stock price has plummeted by 10.44% due to several key news events related to its quarterly earnings reports. The most significant factors contributing to this decline include missed earnings expectations, gross margin pressures, and revenue shortfalls. In Q3 2025, the company's adjusted EPS of $1.05 fell short of analyst estimates, leading to an 8.24% stock drop post-announcement. Additionally, a significant stock retreat in September 2025 saw the share price dive by 26%. The Q2 2025 results also disappointed investors, with the stock falling 21.71% despite beating EPS expectations. These instances of disappointing earnings reports have driven the company's stock price decline, overshadowing its strong revenue growth and strategic shift towards higher-margin owner-direct relationships (ODR) business. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth is primarily driven by the successful execution of new contracts and projects, effective management of operations and cost, and the ability to recover on claims brought against contractors. Additionally, strategic acquisitions such as Pioneer Power, Consolidated Mechanical, and Kent Island have contributed significantly to revenue growth. The acceleration of existing business in the ODR segment has also played a crucial role. On the other hand, revenue decline is mainly attributed to decreases in contract liabilities and an increase in net underbilling position for contracts in process. Revisions in contract estimates resulting in material gross profit write-downs have also contributed to revenue decline. Overall, revenue growth is driven by strategic acquisitions, successful project execution, and effective cost management, while revenue decline is primarily due to changes in contract liabilities and revisions in contract estimates. Net income and profit margins. A shift in performance. The company's net income has experienced a significant increase of 18% in Q3 2025 compared to the same period last year. This growth is also reflected in the year-to-date YTD figures, with a 27% rise from $21,033 to $26,764. However, this expansion comes at the cost of profit margins, which have decreased as a percentage of total revenue. A closer look at the profit margins reveals mixed trends. The gross profit margin has seen a slight decline in Q3 2025, dropping from 26.9% to 24.2%. Conversely, the YTD figure shows an increase from 26.8% to 26.4%. Operating income margin has also experienced fluctuations, with a rise in Q3 2025 and a decrease in YTD. The reasons behind these changes can be attributed to several factors. The acquisition of Consolidated Mechanical has expanded the company's reach into new markets, contributing to increased revenue and gross profit. Additionally, the reduced risk and exposure to large, complex projects have likely played a role in the shift towards higher net income. Furthermore, evolving offerings and acquisitions are believed to have contributed to expanding margins. The company's financial performance indicates a consistent generation of positive operating cash flow. As stated in the summary, this trend is evident in both years, with net cash provided by operating activities being positive throughout. This suggests a stable and healthy financial position for the company. The company's financial health has undergone significant changes in recent years. A review of the debt level reveals a substantial increase from $27,239 to $61,888, indicating a notable rise in liabilities. Furthermore, long-term debt has also increased significantly from $23,500 $554 to $56,275. In terms of interest expenses, there are conflicting reports. However, one clear indication is that interest expense decreased from -$468 in 2024 to -$1,223 in 2025 on page 3. On the other hand, page 41 shows a significant increase of 68.1% in interest expense from $1.375 billion to $2.312 billion. Overall, it appears that the company's debt level has increased significantly, while interest expenses have shown mixed results with both decreases and increases reported across different pages. The company's financial performance varied across different segments and regions. The ODR segment stood out with significant revenue growth, a substantial increase in gross profit, and notable contribution to overall revenue growth. The GCR segment also performed well, with an increase in gross profit of $4.3 million. However, the GCR segment experienced a decline in revenue of 4.7%. Consolidated Mechanical saw an increase in SG and A-related expenses, indicating some challenges in this area. Overall, while there were pockets of strong performance, certain segments and regions required attention to improve their financial health. Management's outlook on company strategy. The company's short-term results do not necessarily reflect its full-year performance. Despite this, management remains optimistic about the company's prospects, citing expansion into new markets through strategic acquisitions such as Pioneer Power. The acquisition has expanded the company's footprint in the Midwest and opened up new geographic markets. Management is focused on growth and compliance, with key objectives for 2025 including improving profitability, generating quality growth in operations, expanding margins through evolved offerings, and scaling the business through acquisitions. A particular emphasis is being placed on growing the ODR segment, which yields higher margins than GCR segment work. To achieve these goals, management plans to acquire strategically synergistic companies to increase cash flow and operating income. The company also intends to deploy free cash flow to reduce its borrowings under its revolving credit facility. Overall, management's outlook is positive, with growth expectations in the ODR business expected to positively impact cash flow trends. The company's financial summary reveals that it has taken a conservative approach to shareholder returns by neither paying out dividends nor engaging in share buybacks. This decision suggests a focus on retaining earnings for future growth and investment opportunities, rather than distributing profits to shareholders through these traditional means. Concerns about inventory buildup or supply chain disruption exist. The company faces significant concerns regarding inventory buildup and supply chain disruption. Rising trade tensions, global conflicts, tariffs, labor disruptions, and regulations are contributing to supply chain vulnerabilities and pricing fluctuations. Geopolitical risks and macroeconomic events pose a threat to operations, supply chains, and end markets. These disruptions may delay projects and impact the conversion rate of backlog into revenue, highlighting the need for careful management and contingency planning. That concludes the financial summary for LIMBACH Holdings INC. Feel free to comment below, and I will be happy to answer them when possible.